Hey everyone, this is Dr. Duru from Ahan Analytics with the Market Breadth. I have some exciting news. Swingtradebot, my favorite stock scanning program, has rolled out a new feature in its IPO scans. All right, let's just dive right in and I'll show it to you. You just click on the menu, go to recent IPOs, and the new feature is they have added the IPO price. I have always wanted to see this because I never want to buy an IPO below its IPO price because that is what we call a broken IPO. And sorry, IPO is for initial public offering. That's when a company issues shares to the public market for the first time. And these are supposed to be opportunities to invest in growth. So companies, they come to the public markets because they want the funds from selling those shares to basically expand and grow. There are all sorts of other reasons why companies come to the public markets, and those reasons we don't like. For instance, they just need to pay off debt. That's like a no-no for me. But anyway, if a stock trades below its IPO, it's broken. If it trades below its open, I call it sort of quasi broken because that means that the stock came to market above its IPO price, which is great, but then people didn't believe in that opening price. So because we have very limited information sometimes on IPOs, the price action becomes very important. All that to say, having this IPO price now in SwingTradeBot's recent IPO list allows me to then get a good reference point. And of course, there's this column here for percent from IPO price that helps me to do the basically the percentage calculation to know just how far away the stock is. Now, the default view on recent IPOs is to sort in descending order, sorry, ascending order in terms of the age of the IPO. That's not so useful when I'm doing the scan. What I want to do, first of all, is do percent from IPO price. And I'm going to sort from ascending from the highest to the lowest. And you'll see why in a second. So, of course, all of these stocks, if you were lucky enough to get into the IPOs, these are fantastic. These were fantastic investments. But what I want to show you is that these fantastic investments run out very quickly. So you see there's 8 pages of IPOs. I'm going to scroll through. You see a lot of big winners. This is again from IPO price, not the open price. And look at that. We've already run out of stocks after the third page that have gains from their IPO price. Again, not the open price. Now, there are some still blanks, and SwingTradeBot is still working on its data sources to fill out these empty spaces. So let's just assume that 50% of these empty spaces are up, stocks that are up from the IPO price. And I say that because as soon as we get to the fifth page, we now start to see all the stocks that are trading below their IPO prices. These are my no-no stocks. These are my absolute no-no stocks. I'm not even going to bother looking at these. And I definitely do not want to short recent IPOs because they often are thinly traded, very volatile, and can pop at any time and can just destroy shorts positions. So much rather go on the long side. So let's go back and now I'm going to narrow down in terms of a few stocks that I like. So what I want to do is get stocks that are not that far away from the IPO price and that are potential trades. And I have a few that I've identified, and I have a bunch of other criteria that I will talk you through. And notice this column here, volume, helps me to also call out stocks that are just too thinly traded to bother with. For instance, this one here, NASA's Pharma Limited, which is the one that's closest to its IPO price. I could swing over here and you can see it's barely moved at all. And very uninteresting chart, but also only 3,300 shares traded. I'm not going to bother. I mean, it's 28 days from its IPO. If people are really all that interested, it should have much higher volume. But now we get to the good stuff. Klarna Group made a lot of headlines. It's a fintech company, does from Europe. It does that buy now, pay later stuff. I'm going to swing over here. You can see it's only 2.3% above its IPO price. And today it's down 4.5%. So it is very close and not looking good. The IPO price is 40 and now it's trading at 40.92 as of the time of this recording. That's a close call. So what I do for stocks like these, I'm just going to watch to see whether it can bounce off of 40. You could see it already did that on the third day of trading. Sorry about that. Let me just go here. And you can see that Klarna conveniently bounced away from the $40 IPO price on that third day of trading. You could see here, Klarna got as high as, what is this, about 55 or so on the first day of trading, and just sellers have taken over since then, except for these 2 days. So this is the characteristic of a lot of IPOs, a lot of wild pricing, because the market doesn't there's a new issue, and sometimes the market just doesn't really know how to give a good valuation for the risk involved with the company and the business. Okay, so KLAR goes on the watch list, but I am not interested in buying. Next up, LB Pharmaceuticals, ticker symbol LBRX. This one did catch my interest. It's only 4.7% away from its $15 IPO price. Conveniently, that's all of the gains for today at the time again that I'm recording. So that means this stock has basically stayed close to its IPO price. Now, maybe I'll cover this in a separate video. I also have a biotech analysis template that I developed in ChatGPT using and training my model based on other biotech companies. So LBRX is a clinical stage, meaning that they came to IPO because they needed the money to fund. Again, remember, we like it when they need to fund the next stage of growth. And in this case, they had fantastic phase two results, and they needed the money to fund the next phase, which is phase three trials. So the caution here is I like this, but it's very speculative. I'm just going to probably buy a few shares, a small amount of shares. Very speculative because, yes, the phase two results are extremely good. And sorry, I forgot to mention this drug is in the psychiatric field, and the phase two trial that went really well was a drug for schizophrenia, and they have other drugs for like bipolar disorder and so on. And it's a very competitive field, according to, again, to the model that I've developed in ChatGPT. So I consider this very speculative, despite the good results from phase two. But I do want to be in there just in case the phase three does go well. Okay, so this one is going to be on my buy list. Okay, next up, I have two that are conditional. Fat Pipe, ticker symbol FATN, and the other one is Netscope. Yeah, Netscope NTSK. Now, Netscope is 23% above its IPO price, and Fat Pipe, you gotta love that name. It's gonna be a meme stock someday, I'm pretty sure. It was up 14% from its IPO price. Now, the reason why I say these are conditional is because both of these companies have software in IT infrastructure. You can call them networking software stocks, but they're both of them have old technology, fat pipe dating back all the way to 1989, according to my cousin who has her own IT company. So I defer to her for knowledge, for information on these kinds of companies. Netscope is a little bit more modern, 20, as she said, 21st century. But none of that stuff really matters when people are betting on the future. So anyway, I'm keeping an eye on these. Like I said, they are conditional. Fat Pipe is actually trading pretty well. I noticed in its chart, it had a big up day recently. It was up almost 50% last week, one day, but I didn't see any news. And again, this is like I said, you don't want to short recent IPOs because at any moment, for any reason, they could just soar. And I saw no news. I went to StockTwits, just a bunch of chatter, didn't explain it at all. You can see on its first day of trading, it was up. It opened up at, what is this, almost 650, and traded almost as high as 15, over 15. So more than doubled on its first day of trading from the open to the high. This is clearly a very wild stock. And because it's close to the IPO price, I'm much more willing to speculate on that one. Netscope is a more recent IPO, and I don't like this chart. And I guess I could have shown this in SwingTradebot itself, but you can see that it came out the gate swinging and is now in that downswing. Now, if it can close higher today and the next day, then it would get back onto my buy list. But right now, this one looks like it may have already peaked out. Okay, now I gave you examples of ones that I kind of like, and put on the watch list. Last one, Aether Holdings Incorporated, ATHR, is an example of a stock that I don't like. It's only about 17% from its IPO, but look at this chart. This stock is basically has had its run. This is the kind of chart that I look at. I just assume it's already had its run. It had a big run up earlier this year. Sorry, soon after the IPO, and it's been trading down ever since. So even though it's only about 17% above its IPO, it was so much higher before. You could see here that it was up as high as $18, over $18. And now it's trading at just around 5. This is a broken stock. I don't want anything to do with it. If I were to speculate, I would want to dive deeper into this one. And Aether Holdings is a trading platform, software platform for traders. I think it provides, research and all that kind of good stuff that we traders like. Okay, so that is it for the IPOs. Now, this new feature was very timely because a recent article in Net Interest talked about how bad of investment IPOs are. So this is important context for the trading rules that I just told you about, because this will help you understand why I'm so tempted. Um I talked about trading, not investing in these IPOs. So this is a quote from Net Interest quoting another research study published in 2021 that found only 30, let's just call it 39% of stocks that went public between 1979 and 2020 showed a lifetime return higher than the return of holding treasury bills over the same horizon. That's awful. So if you think about a risk-adjusted return, these stocks are terrible because the risks are so much higher with IPO stocks than holding treasury bills. So, and even among the high performers, that's the IPOs, the best returns were concentrated around just a few names. Oops, sorry. The authors calculate that around 3%, just 3% of the over 11,000 IPOs they analyzed generated all of the return from IPOs. The rest combined to match the return of treasury bills. That is a terrible landscape. You might as well be gambling. IPOs are essentially gambling. So the advantage of waiting until stock opens is that you greatly reduce your risk. You get to see how the market treats the IPO. And if you want to reduce your risk even further, you wait until the earnings report to see how the market responds to that and whether the company can continue the promises, all the great promises it made on its roadshow and in its S1 going into the IPO. And then if you really, really want to be conservative, then you wait until the first lockup period is over. And that's when insiders dump their shares or some amount of their shares, basically to reward themselves for all the hard work they did getting the company to the IPO. All right, if you have any questions or feedback, put them down below. Thanks for checking this out. If you want more video like this, of course, subscribe, hit that notification bell to get notifications for the next video. And of course, like and share this content so the algorithm knows what's up. This is Dr. Du from Ahan Analytics and the market breadth. I will check you out the next time. Take it easy.